Hey everyone, in today's show, we're going to talk about how to analyze a deal in 5 minutes with the master himself, Rafik.
Thank you, Stas.
So let's make it simple. What's your first step when you walk into a property?
So first off, I want to start with identifying investment real estate as a income producing property.
Okay.
Your number one goal in understanding real estate is knowing what kind of income it can produce and what kind of cash flow you can get after paying all the expenses and debt service. If you understand the current income of the property and potential income of the property, the difference between the current and the potential income will basically demonstrate to you the potential profitability of the flipping of that property or potential for creating cash flow.
Okay, so what type of information do you need up front to be able to determine whether that deal is going to work for you or not?
So generally speaking, in identifying a investment real estate, first thing we do is look at the offering memorandum, or if you are just looking at MLS, if you're looking at duplexes or fourplexes,
Sure.
You want to look at the total potential income of the property or total current income of the property. So with the current income of the property, you will identify expenses,
Okay.
because they will be provided to you by the realtor or
Sure.
broker, commercial broker. All your gross income, all the gross rents, minus all the expenses gives you net operating income. And depending on where you're located in the market, you divide that net operating income by what's called a cap rate.
Okay.
And the cap rate will give you the idea of what that property will sell for once the building is stable. Most of the time, we don't buy properties that are fully occupied or leased. We
Sure.
buy properties with vacancies, 30, 40, 50% vacancies. Or if the property is full, but the rents are under market, that's the other indicator of a potential ability to create value.
Okay. So let's go back to this question. How do you know that the net operating expenses are actually what they are? How do you find out and double check that from what the landlord tells you, the owner tells you, and the broker tells you? How do you double check that stuff just to make sure that everything's in line? Right.
Generally, when you purchase a property, you get 45 to 60 days due diligence period,
Sure.
where you review all of the financials, you order an appraisal, environmental report, and in that discovery process, you will collect financial documents from your seller. And most of the time, those are Schedule E's on the return, or if it's an LLC, if the property is held in an LLC, then you just get an LLC return for the last 3 years, and we just do weighted average income and expense ratio. Now, once you have experience in understanding real estate, then you can sort of project certain savings, or maybe if the expenses are lower, you can kind of understand what the expenses will be from having done it, on many other similar properties.
Of course. How do you determine that that property is going to be able to get filled out, fully occupied within a short period of time, or if that area is going to see growth in the near future?
What we look at is similar neighboring properties. So if it's a duplex, fourplex, if it's a multi-unit property,
Sure.
Or a retail, we look at adjacent properties and see, first of all, the kind of rents that are being charged in those properties and the vacancy factor.
Okay.
And whatever the vacancy factor in the immediate neighborhood, you can talk about it being, a city, or within a 3-mile radius. You can do a searches and understand what your competition looks like,
Sure.
and then sort of project your rents. I always try to put a 10% discount on whatever the comps are. So for example, if the rental rates are $12 a foot or $18 a foot, I try to create my projections at 12 minus 10% or 18 minus 10%. That's a conservative approach, because if you are competing with somebody else and you provide a better value, the tenants will potentially, hopefully come with you.
Okay.
The other things that I look at outside of income, you want to know the size of the property, which is square feet of a building, and then you also want to find out how big the lot is.
Right.
The biggest thing in understanding the lot is immediate location as it relates to some thoroughfares or streets and accessibility. And another thing that's important is a parking ratio.
Okay.
In a retail building, for example, parking ratio will be around 4 or 5 per 1,000 square feet.
Okay.
In industrial, it can be smaller, 2 to 3.
Okay.
Office is the same, 4 to 5 per 1,000 square feet. And those metrics will allow you to understand how you stack up against your competing properties.
Of course.
So,
okay. Let's go through, you're a math complete whiz from just being around you and you being able to calculate all these numbers in your head. So what are some tricks and tips for people out there that are walking into these properties and to be able to figure out in 5 minutes you can pretty much underwrite the whole property, right?
Yeah.
And know whether you're going to be able to get finance on it or whatever else you need to do with it.
If you understand what the net operating income is today, you pretty easily can identify your ability to finance the property. There is a term called debt service coverage ratio. The banks will allow you to borrow at 1.2 debt service coverage ratio. In other words, if you have a $12,000 of rents per month, the banks will only lend you $10,000 in a mortgage payment against that property. Sure. So that's the first thing I look at. How much can I borrow against the property?
Okay.
And if I have net operating income of, let's say 100,000, I divide it by 12. It's an $8,600 a month payment. Sure. Then that means I qualify for about $7,000 a mortgage payment. Does that make sense?
Of course.
So debt service coverage ratio is extremely important. But the main thing is to understand the expandability of the property and how much more rents we can get from leasing the balance of vacant space.
Okay.
What would be the income of the property once it's fully stabilized?
Sure.
Now, when you assess the income of the property fully stabilized,
right,
and your NOI is going to be now higher than your current NOI, that's where you create your profit margin.
Sure.
We try to buy properties that are 30 to 40% under market.
Okay.
And then once you stabilize it, that allows us to refinance the property and take out our down payment or equity capital.
Okay.
Within a year or 18 months. Okay. That's one of the strategies we use.
Sure. So what about this? You want the property, you love it, but you figure out that there's no way that a bank is going to be able to finance this property in its current state. What do you do then? Are you just SOL or is there other ways?
Okay, so if the bank is not going to finance the property, it's a problem that not only I will have, but most other buyers. Unless somebody wants to buy it cash.
Sure.
Generally, if the property is not financeable, then people don't want to pay cash for it. Very often ask the sellers to participate in financing.
Okay.
It can be a contract for deed, it can be a note and a mortgage secured by the property.
Sure.
If the seller is stuck on a particular price, we're okay selling, buying the property at the price they're asking, but then we want the terms that are much more favorable, like a less down payment, 10% versus 25.
Yeah, as they say in real estate, you can either have your price or you can have the terms,
That's
right?
right.
There's no both ways, so it's got to be a win-win for everyone.
Absolutely. So identifying the potential income is very important. And expandability of the project. Can you build on it? For example, you buy a 20,000 square foot property on 3 acres.
Right.
And that extra land can be expanded onto and income can be created. So all you do is look at the formula and especially if you have a tenant, right, it's very simple to identify an opportunity to expand the property and make extra cash flow.
Of course. Awesome. Well, I think that tells everyone how to identify it in 5 minutes.
I hope it does.
It's pretty easy. If you guys have questions, if you're looking at real estate, feel free to reach out.
And we can help you to identify any property if you have one under contract or looking at investing in real estate.
Otherwise, too, if you have a property that's not really market ready, if it's distressed or anything like that, reach out as well.
Absolutely.
Because you might be interested in purchasing that property as well.
Thank you.